Hello, this is Tokyo. Be working on section 24I today, that is foreign exchange differences, and that section is a pretty easier section to understand, except that it is difficult when it comes to answering the questions that comes with that section. The reason being that there are a lot of conditions that need to apply for the exceptions, and also it is also trickier to know what amount of details, especially for the discussion questions, or to identify the triggers or the scope of that section in order to apply it correctly. However, I will be working on some of those things, but I suggest that soon after watching this video, go back to your legislation and highlight and read your legislation carefully. But do that after you go through all these examples that I'll be providing here and the explanations that I'll be giving, so that at the end of the day you understand what you're looking for in your legislation. So before you go on to complicated questions, let's walk through those examples, and contact me should you have any questions so that we can work on those too before you do complicated questions. Like I usually say, it is imperative that you know the basic first before you attempt the complex questions, because complex questions test your knowledge and also exam technique. You do not fix your mistakes, you don't fix your gaps in knowledge by doing complicated questions. It doesn't work that way. So please, I beg you to understand that, and also to know when to attempt a question, and also how to attempt it, how to mark that question, because it is important and it is critical for you to understand that. So let's quickly walk into that. So we'll be doing the text consequences, the exceptions, and also the rules. It is important for you to know the definitions, and for those your tutorial letters or your module or study guides, they provide you with the definitions that you need to know. So I'm not gonna spend time explaining that, because you can understand. The reason why I'm saying you need to know the definitions is it is important. In a question, they don't define a term for you, they just tell you, and you need to know whether it is whether it's a foreign exchange operation, whether it's a translation date, whether it's an acquisition date, or it's a settlement date. So you need to understand those things in order to apply them correctly in a question. Otherwise, you know the theory, but you don't know when to apply it and how to apply it. So at this point in moment, if you haven't gone through those definitions, just click pause this video and go to your legislation and read those definitions and understand them. Contact me should you have any problems, and I'll be able to help you sort them out. So the first thing, like I said, my approach to studying taxation, and the approach that I advise everyone watching this video, is first know the scope of that know the scope of that section that you're studying. After knowing that scope of the section that you're studying, know the implications, what happened after you apply that section. Then after knowing that, then you can go on and do basic examples. After doing basic examples, should you have any problems, go back to your legislation, go back to your textbook, go back to your study guides, go back to your slides, and work through those problems. And only after you are comfortable with that, or you feel you are comfortable, you can explain that to someone who is just walking by the road, or you can explain this to your grandmother to understand that what section 24I is. Then you can now go to attempt the questions. In that way, you will make sure that you know what you're doing exactly. So what is the scope of this one? It applies to a company. So all companies, as long as you see a Pty limited, an incorporated, or a private limited, or a limited, that is, as long as it's a company, this section applies. Any trust that is carrying on a trade, so it doesn't apply to trust that just for example receives just donations. It's not a trade, so it has to be carrying a trade for you to apply section 24I, because in the exam they don't tell you which it applies to this section. You need to know where to apply it. Then it also applies to natural persons that are holding amounts contemplated in A or B of the exchange items, and also natural persons or trust holding amounts contemplated in B or C of the definition of exchange items. There is one exception to the application or to the scope. It doesn't apply to non-residents unless it is a permanent establishment. So as long as it's not a permanent establishment for a non-resident, you don't apply this section. Otherwise, it's gonna be disaster. So please always remember that scope before you go ahead and apply your section, apply your knowledge, because sometimes you know what you're doing but you're applying the wrong section to the given scenario. You're using a wrong solution to give your answer, so your answer is right but you're applying it incorrectly, or you're applying it to an incorrect scenario. So what are those ABC of exchange items? Let me just go and check that for you, and then we can explain and work through that. So item A is a unit of currency acquired and not disposed by that person. For example, if you have US dollars that you bought, that section applies to those US dollars. Then B is you are owing that a debt to someone. So if you apply a loan and you get a loan in US dollars or in British pounds or in euros or in any other currency, then that section also applies to you for those two scenarios. Then also, if you owe as a result of a forward exchange rate, it applies to you, or also a trust that carries on business. So if you carry out a forward exchange contract or an option, that section also applies. Then also when there is a contingent right to get that currency or to get that option, then also you can apply this section. So those are the 4 scenarios that you can apply this section. Other than that, section 24I does not apply. So it is important that you go through your section, you highlight important items, and also you know whether you're applying the section correctly. In the exam, before you apply a section, it is important to just scan through and see whether you are applying that section to the correct scenario. Otherwise, you'll be wasting time writing things that does not apply and won't be on the memo, and at the end of the day you won't do very well. So the one subsection that is critical that I'll start with is subsection 4, which deals with bad debts. So this one now, there is one thing that I need you to note, and I will read it out for you, and I need you to also go to your secretarial act and highlight that part before you can complete. So if you go to subsection 4, it says, subject to section 11, in determining taxable income of any person contemplated in subsection 2 in respect of the debt owing to that person. I just wanted to note that to that person there. So on this one, it doesn't apply to debt that is owed, that you owe to someone. That debt should be owing to you, that is, you have the right to claim payment or you have the right to receive payment from someone. That is when this section applies. As long as you don't have the right to receive or you have an obligation to pay someone, you do not apply section 24, subsection 24I, subsection 4. It applies to the person who has the right to receive the payment, that is the creditor. That when it applies, not the debtor, or it applies to the person who receives the payment. So if you owe to someone, you don't apply, but if someone owes to you, now you apply. It is important that you mark that too very carefully, otherwise you apply it into an incorrect scenario. However, having said that, if that debt is written off, the consequence is simple. It's just a reversal of what you did before in the year that debt was written off. Let's say, for example, in year 1 you had a gain that you included, in year 2 you had a loss that you deducted. Now in year 3, that debt, you wrote off that debt. That gain you just deduct, that loss you just add back. So it's just reversing what you did, but you do that in a year when that debt became bad or that debt was written off. So it is important that you remember to do that and you do those signs correctly. What you added, you reverse. What you reversed, you add back. I think that one is simple. I just wanted to note that it should be the debt that is owing to you, not that you owe to someone. Then let's just do a basic example. So if you cannot read that quickly, you can just pause and read, then continue the video. And Peter here sold machinery to his customer in Germany. The sale was on credit and the selling price was payable in 60 days from the date of shipment, free on board, that's FOB. The selling price was 750,000 euros. The exchange rate was €1 to 17 rand and on the date of the sale. On 28 February 2019, the sixth day of the term, the exchange rate was 1 to 15 rand. On 7 March 2019, Peter received a notice that the company has been the customer had been liquidated. The exchange rate at that date was 1 to 19. What are the tax consequences for 2019 and 2020? There are a few things that we need to note here. It's payable in 60 days, but that 60 days is the 60th day is 28 February 2019. So Peter here is a natural person, so you should know that Peter is a natural person here. So taxation, in order to answer a tax question correctly, there are two things that you need to figure out. One is who the taxpayer is. In this case scenario, is Peter. What is the transaction, the sale of the machine, and that exchange rate owing to him? And then after figure out those two, the last final important thing that you need to figure is the year of assessment. That's the 2019 year of assessment. It ends on the 28th of Feb 2019, and then the 2020 year of assessment starts on 1 March 2019. So it's important for you to understand that. So in this scenario, what Peter does is, in the first year, that is the 2019 year of assessment, Peter sold that machine and he has to translate that 750,000 at spot rates or at average, if there was an average, because Peter is a natural person, so he has that option to use a spot or an average. So you need to check that one, but I didn't give any average, so we just use the spot rate that is there. So that amount is gross income, that is 750,000 times 17, that will give you 12,750,000, I think. Then that amount is gross income. Then on 28 February 2019, the date hasn't gone bad yet because it's still 60 days. So I said in 60 days, it means on or before the 60th day, and the 60th day is 28 February. So on 28 February, the date hasn't gone bad yet. So now this one is a year end. So what you simply do is, what was the exchange rate on the date of the transaction? That was 17. Now the exchange rate, sorry about that. Now the exchange rate is 15. So he made the exchange rate, the rand strengthened by 2 rand, which means that Peter is now worse off. Per every pound that is owing to him, you're supposed to receive 17 rand, but now he's receiving 15 rand. So that 2 rand loss is an exchange rate loss that he has to deduct to get as a deduction or as an allowance. So that 2 rand and 750,000 will give him 1.5 million. 1.5 million will be deducted in his income. So as you can see here, the sale of the machinery included in gross income is 750,000 times 17, which gives us 12,750,000. Then the exchange rate loss is 15 minus 17, which is 2 by 750, gives us 1.5 million. Then in 2020 year of assessment, what happened in 2020 year of assessment? I'm sorry about the presentation. When I clicked the present, the numbers just jumped around, but that's fine. I think you can just see that. So now what happened in 2020? In 2020, he wrote off the dates. So he has a deduction there for a bad debt, which is 12,750,000. Then in 2019, there was an exchange rate. In 2019, there was an exchange rate. This was supposed to be a 2020, not a 2019, but it happened also in March. So that exchange rate gain was from 15 to 19. That happened from between 1 March and the day that the date was written off. So now it's 19 minus 15. That's 4 times 750,000. That gives you 3 million. So that amount is included in his gross income. But now we wrote off the date. So now subsection 4 says if that date becomes bad, we have to reverse what we did. So 3 million, then we reverse our 3 million, which is deducting because we had it here. But that 1 million in 2019, that 1 million there, that 1.5 million there was a deduction, but now we add it back because it got a deduction. Now we need to cancel off that. We add it back, that is a reversal. So we reverse that, and the net effect will be this one plus this one minus this one plus this one, which gives us 11,250 million. Not sure if my math is right, but I think it is. So that is the net effect of that transaction. That is the amount, the net amount that you will be getting an allowance for after doing that transaction. But this is the procedure. When you are writing an exam, it's important that you present it also the same way. Now the other section that is more trickier is subsection 7. This one is if these are the conditions, that's the scope for subsection. If an exchange rate arises from a debt to acquire an asset, the reason I used to acquire an asset, it's something that you use or something that you can be brought into use at a particular date. It's not trading stock, it's not repairs and maintenance, it's something, an asset, but there are definitions there. If you go to your X, you can just go and check those out. And it is from a foreign exchange contract or an option. That is the reason that is there, that debt that you take should be hedged, or that item that you bought, you should hedge that transaction before you pay it, for subsection 7 to apply. Then there is an end that I need to check. If you viewed my presentation on that, I told you that with other subjects you can get away with missing an end, an or an if, but in text you will not get away from missing an end or an or a to or something like that. You need to read every word as it is and understand why it is there. So that end there, that highlighted in yellow end, means that all the conditions should be met before you can apply subsection 7. So now end, a premium is paid for the hedge, so you pay something for that hedge, but usually it's this one is an obvious thing, because if you take an option or a foreign exchange contract, you pay a premium because the person who is hedging your risk there is doing business and they should get something out of it, so you pay also a premium for it. Now, what are we saying? Now, such an exchange difference shall be carried forward until the year the asset is brought into use. Now, you look at the following example, the coming example just on the next slide. So, until that asset is brought into use, that foreign exchange difference with regards to that hedging arrangement should not be deducted or added to your gross income. It is carried forward until you bring that asset into use, or that debt is no longer owing to you. Let's say, for example, the person, the supplier wrote off the debt, he waived that rate, that debt ends. Now you can just include those amounts that you carried off before, or any of the conditions of subsection A to C are no longer applicable. If any of those conditions are no longer applicable, like I said, there's an end, which means all 3 conditions should be there to apply. So the moment any one of those is no longer met, then you need to include all the amounts or deduct all the amounts that you carried forward from before. And also there are exceptions that you need to note in that paragraph as well, but those are simple to understand. If you get any difficulties, just let me know and I'll try to help you to sort it out. So this is quite a long example, so I suggest that you pause the video here, read through the example, the scenario, and then you can just come back and we can continue. So now here, Nigel Limited purchased the machine from India, used to perform, sorry for my punctuation, the machine is used to perform heart surgeries. The machine is of such specialized nature that it requires special buildings and conditions for it to operate. Since it is automated, Nigeria to build in rail so that unmanned rail vehicles URVs could be controlled remotely by the machine. The machine was imported on 1 January 2017 at a cost of 250,000. The exchange rate different for 2017 year, assume that is right, so it's a gain in exchange rate. So Nigeria gained in that transaction, that's why there's a plus there of 175,000. In 2018, the rand took a nosedive after political problems in South Africa, and the exchange rate difference was 220,000 in 2018 year of assessment. Then during the completion of the specialized building, one of the URVs crashed into the other, and the whole building caught fire. The machine was written off, no insurance was taken. The exchange rate for the 2019 was plus 12,000, that is, there's a gain there. The debt was settled on 5 April 2020. An exchange rate difference of 50,000 was recognized in 2020 of assessment. and FEC was taken to use that date. So you should note that if there was that forward contract or there was no any hedging, there are sort of that subsection 7 wouldn't have applied there. You just calculate the normal as in subsection 3 and just include those amounts without any problems. So let's check out how we do that. So we need to do the tax consequences from the 2017 to the 2020 year of assessment. It is important that you just sit down, read your act at this moment and try to figure out what exactly happened before you continue to check out how exactly you are required to do it. So now in 2017 year of assessment, he bought that machine, but that machine wasn't in use yet. So the exchange difference should be carried forward as is not yet used, that is 175,000. In 2018, that machine is still not used, so he carries forward the exchange difference, which is 175,000 minus a loss of 220,000, which gives us a 45. So this 45 here is carried forward. Then in 2019, now the machine was written off, so this machine is not going to get used because it's written off. It was destroyed in a fire. So one of those exceptions is now applying. So the moment those exceptions are now applying, then the roll forward or the carry forward provision is no longer applying. So that's now you get all the amounts that you carried forward. If you say 175 minus 220 gives you 45,000, then 45,000 minus 12,000 gives you 33,000. That 33,000 will be an allowance in the 2019 year of assessment. In 2020, now that machine is not gonna be used because it was destroyed in fire. So that exchange difference until the date that it was settled will be a gain that is included in your income. So it is important that you understand how to deal with these scenarios and how to work it out. And please, if you struggle in any way, let me know and let me help you fix that problem so that you won't struggle in the exam and you can finish this and pass your exams. So this is the end of it, and I hope you understand. I hope it takes a simple approach to that section, and I hope you understand how to deal with it and how to approach those kind of questions in the exam. So in the exam, sometimes they ask you discuss the tax consequences or discuss what happens if this happens. So now it is important, if there is a discussion, you need to apply the reason, to provide the reason why exactly you are doing that. So the reason you are doing that is you go to your section. That's the reason, because the section says you need to do so. So you go to the section, subsection 7 applies. So let's say, for example, the last example that we did, they tell you discuss the tax consequences. The first thing you say is there was an exchange rate difference. Again, in the first year of assessment, that amount should be included in the person's income because it's a gain. But then, however, after you say that, you know that should be there, but there is an exception. After you say that, however, the conditions for subsection 7 apply, and you list those conditions briefly, and then you say, therefore, that 175,000 is not included in this year, but is carried forward until that machine is brought into use, or it is established that it's no longer going to be used anymore. After that, then you can just go to a conclusion and say, then for this amount will be carried forward to whatever the year that machine will be used, and discuss it. So you need to discuss the thinking process that you put into that field, into that answer, before you can get to a conclusion. I hope you enjoyed it, and see you in the next video. Thank you very much.